already saturated Cape Town to you all. We are absolutely delighted to host another edition of our Index More series, where we at Satrix, in collaboration with BlackRock, look to bring you insights from the investment trends that shape our world. My name is Nico, Katzke, Head of Portfolio Solutions at Satrix, and I will be moderating this very interesting session, where we ask the questions, are bonds back? We're delighted to have with us today two excellent speakers to provide both a local as well as a global perspective on an asset class that has taken the back seat in discussions for, in fact, most of the year. So following continued market fervor in the technology space and a very strong performance from equities more broadly, it is absolutely no surprise that global bond indices have failed to capture the public's imagination this year. Now, this also follows on from the better part of a decade where the asset class was effectively uninvestable globally, with yields near zero in most developed markets. Post-COVID, with inflation surging and central banks reacting by raising rates, the asset class started to offer something to yield starved investors, albeit still flat on a real basis. Now, nonetheless, it seems the fixed income side of the market has once again started to pique the market's interest, as rate cuts are looking more and more likely to happen towards the latter part of the year. But when it comes to the investment case for bonds, it is not only central bank activities in the short term that matter. Other important facets that need to be considered include the very fluid nature of inflationary pressures, as well as economic activity, and also accounting for the many permutations that different election outcomes this year will likely play in shaping future rate expectations and sovereign debt management. Now, in a year where half the world will be heading to the polls, it makes for a non-trivial asset class to consider, to say the least. Now, those following the markets closely may have noted that the global Bloomberg Aggregate Bond Index lost more than 3% year to date, while the local All Bond Index jumped over 5% in the month of June alone. Now, these type of returns may seem at odds with the name we often use to define the asset class, fixed income. If recent months have taught us anything, it is that fixed income does not mean fixed returns, and that one omits the very real capital risk component of these instruments at one's own peril. But where there is risk, there is possible reward. And with us to make the case for bonds today, by providing us some insight into their world, are two seasoned asset managers. Firstly, we have Karim Chedid, Director of the Asset Manager BlackRock, joining us today from London, and he will share his views on global matters influencing the investment case for global fixed income. Now, sharing with us his views on local matters will be James Turp, Head of Fixed Income Investment Strategy at Sanlam Investment. Thank you for joining us, both of you gentlemen, and I really look forward to this engagement. Now, before we proceed, I'd like you, the viewer, to first give us your take on the outcome of our recent local elections and whether you share in the recent GN euphoria that we've been experiencing. A pop-up box should appear on your screen any moment now. I think it is coming through now. So you should see a box appear, and effectively all it says is, will the post-election GNU optimism last? You have a choice there of strongly agree, disagree, or strongly disagree. So if you can maybe make your pick there. There's, of course, no right or wrong answer, and by all means, try to be truthful and not simply patriotic. Give has legs, and whether you join the optimism that the market has given it. Let's just give it 1 minute for our attendees to put their votes in. Karim, you are welcome to also vote. I'm not sure if you followed South African politics, but if you have, you are welcome to vote.
Otherwise, now that I have your invite, I will use my vote.
Amazing. More than half has voted. Those of you that are yet to vote, if you can maybe press the right button there. You can maybe give it 5 more seconds. A, B, C, or D. There we go. I think we've reached critical mass for our voting. Oof, the numbers are fast coming in for the votes. So I'm almost hesitant to click the next button, but let's say that is now the end of it. And let's see our result. So only 6.9 of you strongly agree we've turned the corner in terms of good governance. 2/3 say agree, we're on track, so it's not a strong agree. And then about 1/3 say disagree, improved governance will likely be short-lived and GNU largely ineffective. And then there's a small pessimistic minority that strongly disagrees and argues that this government will split within this election cycle and be in disarray. Very interesting. So 2/3 of you, maybe, James, when I return to you on the local political front and economic front, maybe just reference those numbers. 2/3 are cautiously optimistic. That's at least giving us some hope that hopefully we've turned the corner. At least you dialing in from home, that's how you feel. Now, I want to first welcome on the proverbial stage today with us Karim Chedid. It's not your first time joining us on the Index More webinar series, and it's great to have you back. So welcome, and thanks again for joining us, Karim.
Great to be back.
Karim. Amazing. So following optimism towards the latter part of last year that rates should have started coming down by now. I think most people were kind of in agreement in December. Rates will have been slashed 2 or 3 times by now. But we've seen rates remain stubbornly high as the U.S. economy have remained strong, and particularly wages remained high. Can you maybe just give us a very brief update on the state of the U.S. economy from your perspective as you're seeing it today, and whether it might still this year give the Fed some room to start cutting rates?
Sure. I mean, to add some numbers to the rightful claim that you just made, Nico, around the expectations at the start of the year versus today, we started the year with the market pricing, and when I say the market, I mean Fed fund futures, pricing 7 cuts for the Fed by end of 2024. Today, none of those cuts have happened yet, so we're still where we were at the top. And the market is now only pricing 2 cuts by end of the year. And in fact, it's, at one point, it was even pricing only 1. And so this has been a big change. Why has that happened, this shift in expectations? And why have the rate cut expectations not materialized? You mentioned the wage strength, and I agree with that. I think also we have had a pretty strong consumer in the US. We've had a steady stream of strong retail sales numbers. The consumer had really eroded their savings cushion after the pandemic to keep consuming, and then even started to take on some credit. And because of the strong wages that you mentioned, real incomes have actually increased year to date in the US, which provided a bit of a new cushion, another second wave of strong consumption. Why did real income actually improve? Because inflation was falling drastically year to date, which is the reason why markets were expecting the rate cuts, because inflation was falling. Disinflation was a big theme. But when inflation falls and wages remain strong, real income goes up because the take-home pay and how much people are spending has actually reduced relative to how much they're earning. So they were in a better place, so they spent more. And that strong resilience in the growth picture in the US, as well as despite the falling inflation, as well as the strong consumption data, has meant that rate cut expectations did not materialize as quickly. Now, as we look forward and the state of the world today, we think that inflation is going to continue falling towards the Fed target by year end. But we at BlackRock are out of the camp that there are structural drivers of inflation that will not go away. Think about aging demographics. Think about the tightness of the labor supply, which has been supported by a huge amount of immigration coming into the US year to date. You only need to look at the net migration numbers in the unskilled and low-skilled labor in the US, especially in the services sector, to see that the huge numbers that have come in year to date, including unregulated migration, have been a huge driver of inflation falling in that segment. So inflation could have been a lot worse year to date had it not been for this migration. So, and now the political rhetoric is really cracking down on this migration, whether it's the Democrats or the Republicans. Both agree cracking down on those numbers as we head towards the November election in the US. And so if you think about this positive driver of labor supply becoming less of a positive driver going forward, so more tightness in labor supply, that's inflationary. If you think about aging demographics, that's inflationary. And if you think about the fiscal spending that we expect to see from the US, regardless of who wins the presidency in November, that is also inflationary. So we are of the camp that even though inflation will fall this year to target, and the Fed will cut rates, probably in September and December, so twice, in 2025, rate cut pricing, once again, is a bit too optimistic, just like we were at the start of this year. So we expect at the start of 2025, we're going to have a similar reckoning where rate cut pricing of 5-6 times for the year will not materialize. And even more in 2026, where rates are also pricing further cuts. And that will be more difficult to materialize given our view that inflation will remain sticky and actually go back up. And so what this means is that higher rates for longer is here to stay, which doesn't mean bonds are not back. Your title, bonds are back, still applies, but they are back for income, for carry, as opposed to massive total return. So I'll stop here in terms of the opening remarks to your question about the Fed and the state of the world.
Yeah, and if I recall, the last time we spoke, you were one of the few voices that were cautioning on the market's optimism that rates will be slashed this year. So at least in that respect, you've been vindicated. And it's interesting that you point to the fact that rates might stay higher for longer. I think most in attendance would not want to hear that. But you mentioned the political machinations in the U.S. and since the first U.S. presidential debate, we've seen a Trump trade that led the equity market higher in response, as well as the yields a bit lower, which was interesting. And can you maybe elaborate on what we can expect from a Trump presidency as it relates to yield specifically, and whether U.S. policy would be more or less conducive to inflation, fiscal debt sustainability, dollar strength under a Trump presidency? And also, could you maybe muse on whether the picture would be different from a debt instrument perspective under a possible Harris administration?
Sure. I will first respond to your comment about the high rates, and then I want to say three things about your question about the Trump and let's say U.S. election more broadly. The high rates for longer, I would challenge that that's the negative notion. I know why it's sometimes perceived as a negative notion, because the idea that you have restrictive rates is bad for the economy, bad for market equities, etc. But equities have been doing pretty well, even in a high-rate environment. We've had a good year for equities so far this year. We had an excellent year for equities last year. So I think the delta around going from low to high rates is painful, but which is why 2022 was a rubbish, horrible year for equities. But once you're there, it's actually not that bad because, frankly, it's the end of financial regression. Negative rates were pretty bad for saving, for investments. So having some rates is actually, a normal for if rates are at 3-4% and equities are returning 10%, that's not bad. Bonds are giving income, that's not bad. So I would challenge that notion. But on the US election, I would say three things. The first is defining what a Trump trade is currently still an art, not a science. What you're calling Trump trade, quote unquote, over the past few weeks was a rotation into value and small caps. But the jury is still out on whether that is actually a Trump trade, because we're also hearing from President Trump potential that he wants to make it easier to supply oil in the US. That would actually potentially drive the oil price lower, which means that some of those value and small caps parts around energy and cyclicals would not do as well as you would think. Similarly, he is actually making, in his long interview that he did with Bloomberg, there was some comments around that might suggest that some of the geopolitical tensions globally might be less of a driver. So he made some comments that are less inflammatory when it comes to U.S.-China tensions or other global topics. And so that actually might be counterintuitive to what initially was being defined as a quote-unquote Trump trade. My point is that it's too early to define what a Trump trade is. We like to stick to fundamentals. We have not leaned into the value and small caps rotation, primarily because earnings don't back it. Earnings are still very positive in tech, mega caps, quality stocks, and we're still focusing on that as we progress in the earnings season, as opposed to leaning into this rotation that we think is short-lived. However, so that's the first point. The second point is I would look at the US election as a way to think about which exposures are well-positioned anyway, regardless of outcome. So the way that I think about it is positioning in an election year as opposed to positioning for an outcome, because positioning for an outcome can be quite binary. So I'd rather the former in terms of portfolio positioning. So where does that keep me focused? I'm focused on areas like tech, where we think earnings are driving it still. I'm focused on areas like financials, where US banks were punished because of the expectation of rate cuts that have not materialized. They now look cheap, so I like to look at that. I'm also focused on sectors that benefit from fiscal spending regardless who's in power, regardless who wins. And here it's focusing on things like US industrials, who benefit from the AI build-out, and also benefit from fiscal spending to bring manufacturing back to America, regardless who wins. And so those are some of the areas I'm focused on going into the vote. The third thing I'd say is we're going to get a bit more clarity on policy the closer that we get to the vote. But generally speaking, elections are not huge market drivers in the longer term. So it's all about your time horizon. But if you zoom out and you focus on the longer term, it almost always, in fact, strictly always, pays off to stay invested through the event volatility as opposed to try to time the market.
I think that's a great point. That's always something we've been at pains to stress as well, is that it's about staying invested over the long term and not trying to time your entry and exit points, because a lot can happen between now and November, not only in the US. In fact, while the US will certainly be front and center for many analysts looking to the second half of the year, other elections taking place around the world. And a central theme amongst them all has been the strong undertone of nationalism and protectionism that we've seen in Europe and elsewhere as well. Now, what impact do you think this increasingly, call it isolationist shift in politics, have on the medium-term global inflationary outlook, specifically rate cutting towards the end of the year, perhaps into 2025, 2026, if the political outcomes kind of move more towards that isolationist potential regime? Because I take your point, elections matter only up to a point, but surely if countries move towards being more protectionist, the inflationary impact of that, the secondary impact of that will likely last far longer, shouldn't it?
Yeah, absolutely. I agree with that, Nico, and I think it's not at odds with what I said around the elections market timing point, because I think I would go beyond the elections to focus on what we identified at BlackRock as a mega force. Mega force being something that is a structural driver for returns over the long term, market returns over the long term, and could also be an investment theme in and of itself. And one of the mega forces, we've identified 5, and I won't go through them all now because we don't have time. But one of the mega forces that we have identified is geopolitical fragmentation. And we define this mega force as the fragmentation of supply chains in a way that doesn't deglobalize. We don't think that the world is deglobalizing. It's just changing the way that it is globalized. So world trade has flatlined. It has not reduced. It reduced during COVID for obvious reasons. We shut down the economy. But then it went back to trend. And it's flatlined. So global trade is not accelerating at the pace that it was in the 80s and the 90s during the peak of globalization when, the trade was opening up significantly, tariffs were coming down, etc. Now it's flatlined. And we think that it will continue to be flat rather than drop, even with the increase in protectionism and isolationism. And what it means is that countries will still trade with each other, but there will be more middle countries in between. So think about US and China. Mexico has taken over from China as the largest trading partner of the US as of 2023. But that doesn't mean that there's no longer trade between the US and China. It just means that a lot of it is passing through Mexico instead. And think about the EV example, electric vehicles. A lot of electric vehicle factories have opened up in the vicinity of Mexico City. And a lot of the exports from there are going to the US, but they're still heavily interlinked with Chinese EV. So, and that's just one example from one subsector, and there's many others. So what it means is the world remains globalized. There's still a lot of trade, but it's more inflationary, because the more middle countries you have in the middle, in between, the more inflation you create. And it also means that that there are investment opportunities along the supply chain. So we like Mexico strategically because of this reason, because of the benefit of being in the middle of all of that. India is another market that we like in this context as an emerging market, because it's also a beneficiary of this more fragmented supply chain. Southeast Asia, you don't need all of manufacturing to go offshore from China to Vietnam, for Vietnam to benefit. You only need a little bit, because the starting point in Vietnam is much less. And so Southeast Asia is another area that comes up. But yeah, to answer your question on inflation, it is inflationary. It's one of the reasons why we think inflation will be more sticky in 2025 onwards, and why we see that the R star and the equilibrium rate is higher than what is currently being priced in.
I haven't heard the term R star since my studies. It's a good reminder from that perspective. The long-term rate of interest, and I would agree with you. I think there's a structural shift upward, and it's not for the worse. I think, to your earlier point, you need some real rates, some non-zero real rates to keep the economy functioning. I think for too long it was kind of disjointed from reality, and we've only now returned to some form of normality when it comes to turn to the asset class that's sort of in the headline today, bonds. And just ask you as a sort of last question, can you share some perspective on specifically on flows that you're seeing within the fixed income space, and perhaps with other asset classes as well? Specifically considering the last time we spoke, there was quite a significant inflow into the asset class, specifically as the markets were pricing rate cuts for this year. And so you want to get in on the action. You want to get those high yields while you still can, and benefit from the market rates going down.
Sure.
Capital appreciation that you're seeing. Are you now seeing that investors flow out of that, perhaps to the more class that is fixing that perspective?
Sure. I think that if I'm honest, the flow magnitude relative to the last time that we spoke in this forum, Nico, is a bit slower. So it hasn't been as positive of a year for fixed income flows now as it was in 2023. But the momentum has continued. We're still seeing sizable flows into fixed income. And I think it's a multi-year story. Because going back to the point that I made, and that you then kindly agreed with, around high real rates being somewhat of a good thing, bonds for income are back, and that's still attracting a steady stream of flows. Now we're seeing changes under the hood. We've incrementally seen more comfort taking duration risk, and when I say flows, I'm talking about ETF flows. We have a really good database of overall aggregate ETF flows across the industry, not just iShares. And those flows are becoming a bit more extending duration. We certainly saw a theme of extension of duration in European fixed income in specific, probably more than US fixed income, probably because of the view that the ECB has room to cut rates more because there's less structural drivers of inflation. We also saw flows into credit. Now, in credit, at the start of the year, I think when we spoke, a lot of the flows were centered around IG credit, investment grade. In fact, we had a record-breaking flow picture in Q1. That has slowed down a little bit. We had a bit of an unwind in IG credit, but we're still seeing flows into the high-yield segment, especially in Europe, where the macro picture is looking a bit better than.
Yeah, that's fascinating. I must say that resonates well with me as well. Getting some of that duration, building up that longer duration exposure on the global side, just to get the maximum bang for buck, if you like, when rates start coming down, hopefully towards the end of this year, perhaps next year. But thanks for your views, Karim. Really appreciate that, and I think we all learned a great deal from your insights there. And also, just my takeaway there is be optimistic, or we can perhaps be cautiously optimistic, but I wouldn't bet the house on rates coming down sharply towards the latter part of this year and into next year. I think to your point, inflation might remain higher for longer, and we should accept and embrace a world with slightly higher interest rates than I think our past decade is not a good bellwether for where interest rates should be longer term. But thanks for that, Karim. I want to next invite James to the panel. Thanks for joining us, James, and making your debut on the Index More series. Now, those of our viewers that haven't seen James on television, he is a television star. They're in for a real treat, I think, because James says it like it is. So thank you for joining us, James. It's great to have you on. I want to start off, James, by giving you a broad and open canvas on which to paint for us a picture of your view on the local political landscape post the historic May elections, where the ANC, for the first time in its history, lost its majority vote. Now, does the GN euphoria differ from the short-lived ramaphoria of yesteryear, or are you seeing positives in what many have pointed out as a new dawn, specifically as many of the less market-oriented voices in the ANC have splintered off, and a more pragmatic side remains that's kind of trying to create a market-friendly environment? Certainly the rand has strengthened and bonds have rallied in response. What's your take on it? Are you optimistic that the wind is behind our backs firmly now, James?
Nico, good morning, and thanks so much for having me as for my first time, and to be associated with Satrix on this amazing platform. Thanks for that. And a great question to start off with. And I mean, looking straight at your polls, that's kind of indicative of how I'm feeling at the moment. Now, just to frame my thinking about South African government bond investing over the last 10 years, it's been very conservative and cautious because politically we've had stormy weather throughout and very few periods of positive developments. And then suddenly this election comes through and surprising everyone with the way it turned out, this government of national unity. I didn't see anyone really predicting an ANC around 40% and thinking that they could take it out and turn it into something with such buy-in already. So I think there's reason to be optimistic already, similar to the audience's voting around this, because with the messaging we're already seeing coming out is focusing on delivery, focusing on getting the economy growing, and it's also in line with the Constitution, which has been a key part to South Africa's being able to stay above water over the last 30 years, is the critical levers of the economy, the judiciary, the Reserve Bank, the Ministry of Finance, National Treasury, the banking system. All of these things hold themselves highly relative to other international developed markets. And so there's certainly the potential for this to make meaningful change. And going back to your question, how it differs from ramaphoria, the backdrop for emerging markets at the time of Ramaphosa was really supportive. So we saw global bond markets rally. We'll talk about that a little bit later, that we often go with the flow, as you like, or rise with the tide. But this time, I think it's somewhat different. We've got other emerging markets that had performed losing a bit of value, their currencies weakening somewhat, but we've seen rand strength. We're seeing our bonds start to perform based on idiosyncratic potential that exists in South Africa that has not presented itself for so long. So yes, I think there's reason to be optimistic. It's playing out in the bond yields, but we're not without our problems and complications. And of course, politics is a difficult arena to navigate. So there's going to be hard work. There's a lot of difficult issues for government to circumvent and to navigate through. But as we stand, I've not felt as positive about South Africa's political landscape for a long, long time.
That's amazing. Look, optimism is a powerful force. It doesn't solve too much, but at least it's great to have that optimism, that feeling of national unity. You know, if you look at our rugby team, I mean, they thrive on optimism and you know, having this feeling of unity behind it. I think it is a powerful force. I agree with you, James. In terms of the local fixed income market more broadly, as I mentioned, you know, June saw the ALBI jump 5%. I mean, phenomenal returns there. You know, clearly the market was on board with this GNU and perhaps off a low base. Who knows? I think the optimism comes off a very low base. I would argue, if you think a few months ago. Where are you currently seeing, James, the opportunity on the yield curve, given your views on this optimism? Is it in the front? Is it in the belly? Or is the party in the back at the moment, James?
That's an excellent technical question, because what we've seen in the market is an interesting change with regards to the yield curve. And what we've seen ultimately is our yield curve flattening somewhat. In other words, the longer maturity bonds have actually strengthened relative to the shorter maturities. Now, that's not always the way I look at bond investing. I prefer to look at it on a risk-adjusted basis. And the shorter the bond, the higher the yield, the better the payoff, in my opinion. But what we've seen lately is a couple of interesting developments. Now, what we have to take into consideration when we invest in bonds, if we look at the screen, this is the existing debt that South Africa's already issued. So those blue lines are capital and the yellow is the interest. And you can see it's bunched up out to around 2032, 2033 area. So there's a lot of maturing debt that's coming. And what we've seen is government buys this back and issues a little bit longer. They've also issued 2 new bonds where those red lines exist to plug the funding gaps there. But you can see the availability of bonds in the long end, those longer maturities. There's less bonds out there, and those are higher yielding bonds. So in this optimistic rally as it is, we've found that investors have been buying the longer maturity bonds to get the most bang for buck. I see that as a short-term development. I think we're going to see shorter bonds obviously being issued by Treasury. But I think once the dust settles, I would revert back to my original investing strategy, and that's risk-adjusted areas of the curve. And that's something that I think you can see when you stack up the yields and you look at this chart, for instance, on the screen at the moment. You can see the repo rate at the bottom, the white line, is 8.25. Then as we go up that y-axis on the right-hand side of your screen, the blue numbers are 1-year deposit. You can see you get an extra 50 basis points. You actually get less for 3 years. But then as you creep up, can you see how those yields pop up? That 2030, you get another, you're getting up to 9.6, a couple of years further, closer to 10.5. And those long bonds, you get a full % extra. But when I talk about that risk-adjusted, I want to sit somewhere around that green line personally, because I think then you're getting a good balance of risk versus reward. And that's strategically how I think bonds will play out over the next year.
It's very interesting. I love this slide, and I think it's important for us, for our viewers at home, to just take in how steep it becomes once you start to expand that time to maturity of our local yields. Now, so you've shown us, James, that the mid and the long range still offers attractive yields for investors as we speak currently, even after the elections. I mean, it's come down, but it's still elevated. Now, are these elevated yields that you're seeing sort of in the 10+ year time range, is that due to inflation risk, long-term inflation risk, or due to a high default risk premium, or is it instead perhaps a function of significantly lower demand for our local debt instruments? As all of us know, we are non-investment grade. We dropped out of the WIGB. All of this simply means that offshore investors' demand for our bond instruments remain low, and so despite the strong carry case to be made currently, I would argue that global demand for our bonds is limited, structurally so. Now, are we seeing global investors come back, and will their demand start to push prices up and, of course, start to push these yields down in the area of the yield curve that you are seeing opportunity at the moment? Do you think that inflight of demand will push it down, or is this more default risk, inflation risk? How are you seeing that picture?
Again, that's a really good question, Nico. When we look at foreign activity, the first disappointing point you've made is that we've been downgraded to non-investment grade. So that already curtails the flood of foreign investment that we could have got were we investment grade. So we get removed from some investment grade mandates, of course. So we're playing with the non-investment grade types of flows. I've put a chart on the screen, though, and this is quite an interesting one. So what we look at, the white line is the US 10-year, the yellow line is the South African 10-year. And those yields, you can see they kind of move in a reasonably well correlated fashion. They peak in the middle of the chart where you can see the circle there. And whilst those bond yields are moving higher, look at that confluence of foreign selling, which is demonstrated by the red lines below the zero on the x-axis. So all of the red lines that stack up as foreign selling, and green are days when foreigners have bought bonds. They were selling whilst US bonds were selling off. But now, towards the right of your screen, you can start to see those green lines pushing away the red as it is, and that correlates perfectly with the June election, right? The end of May, beginning of June, suddenly we're seeing those green lines start to tick along. There's a couple of red, of course, but perfectly when you see those green lines, you can also see the South African yield dislocates from the US yield, moving lower on the screen in the final quarter. And that's encouraging. That's that difference of, and this is global investors. And I monitor this chart going back as far as I can. And you really see a tight correlation with our markets' yield behavior and foreign investors. Now, we could take a step back and wonder why that might be. And I see it as foreign investors. We, as certainly financial institutions, for instance, have to hold high-quality liquid assets like banks. So they buy bonds, and they will hold the amount of bonds that they require. Asset managers, non-banking financial institutions, we marginally adjust our bond holdings. But I would say, monitoring the commentary in the market, that a lot of South African asset managers are fairly well positioned in South African government bonds. And so it's the marginal buying from foreign investors that gives us the kicker in yields that this market needs. And that's why we behave like we do when foreign buyers or foreign sellers come through. So this is a great chart to show us that those foreigners who can buy have certainly returned to South Africa. And the foreign investors that I've encountered in discussion over the last month or two have been cautious around the elections for sure, but they also see this as certainly the most positive change in 30 years in South African politics too. And that's playing out. As I say, were we in the World Government Bond Index, that would be a great place to be. But for those that can invest, it seems like their voting and actions have spoken louder than words, as demonstrated on this chart.
And so what? And assuming now, James, and I think you would be cautiously optimistic that the presidency and all the ministers are watching this webinar for sure. And if you can speak to them, wouldn't the sensible message be that, you know, for us to clean up house, to get our spending costs down, specifically when it comes to debt refinancing costs, which are extremely high. I mean, there's so much better we can do with that money in South Africa. You know, put that to good use instead of paying high interest costs on our outstanding debt. Our governance, get us back into investment grade, get us back in the WIGB. Improve all of that so that we can have those foreign flows that will push down or push up the prices because of demand, push down those yields, and that's going to have a massive impact on the government's ability to actually relocate spending that's currently going into wasteful interest expenditure, actually putting that to good use. Would you agree with that? I think it's a massive opportunity, isn't it?
Totally agree with it. I mean, if you think about our own budgets, Nico, if we're borrowing and the cost of borrowing is high, if we're not earning enough to pay that money back, to pay for our home loans or car loans or whatever the case might be, we're soon enough going to find ourselves without resources, without the ability to function financially. That's how I see South Africa, unfortunately. Look at the chart on your screen. The bold blue line is our yield curve. And you can see from where the red arrows are those new bonds. But look at the flat line. That's above 11% from 15 years out. We're paying 11% to borrow money at the moment. That is I think it's, if not the highest, it's the second highest expense item on the national budget is the cost of financing our debt. So if the cost of debt is 11%, you've got to be growing somewhere closer to that in order to be an economically viable country. So the message to government is growth, growth, growth. It's time to focus on employment and growth. And, the good news is certainly the government is making the right noises. Now, we've got one of the best central banks in the world, and we know that they're fighting against inflation. That's a big key to getting things right in South Africa. If we can contain inflation, which affects the lowest income earners in South Africa. So that we've got tied up. And if you look at the chart here, you can see these are inflation break-evens. In other words, this is what the markets infer to be the level, if you buy inflation-linked bonds, that inflation should average over the various periods. Yellow's 5, blue's 10, and purple's 20. And you can see our 20-year inflation break-evens dropped from 8% to 6.5%. From April. In other words, we're factoring in a lower inflation because we've got a competent central bank that the market believes is now highly likely to be able to contain inflation and hand over to the next governor in time to come too. This is an important structural vote of confidence for South Africa. So we've got the market welcoming that, displaying it in the inflation break-evens. So now it comes back to growth. Government's got to focus on it. And, there is room for optimism. If you look at even the new Minister of Sports is making the right noises, talking about, working within his ministry. We've got the Ministry of Finance that is going into the election, has been making the right conservative calls for the fiscus. We had going into the election the continuation at SARS and at the Reserve Bank of those respective governors and the head of SARS too. So the noises are being made correctly at the moment. Now it comes to implementing the harder stuff in the economy in the other various ministries. But the outlook is optimistic. I can say that much.
Absolutely. Now, the MPC met last week, James, and you and I talked almost immediately after they met, and you mentioned that they talk like a hawk, but they fly like a dove currently, you know? And can you give us some color into your reading of the MPC's views, and also whether are they waiting for the Fed to sit at the table before they take their seats, or might we actually see the SARB eager to act at the next MPC meeting? What's your reading of the situation there?
Nico, I remember that we were trying to come up with a good rhyme, right? Talk like a hawk was definitely what they were doing. So if I go through that statement, they were saying things like the battle against inflation is not yet won. That the level of South African inflation is uncomfortably high and above the objective level. So then they spoke about us having the second highest level of inflation in the G20 group. All of these extremely hawkish comments. They also, and I think the key hawkish change for me, if we're looking for hawkish information, was that the risks to the inflation outlook were no longer balanced, as they'd said in May. They said that they were to the upside. So here's on the screen the inflation forecast, and the light blue line is our Sanlam economists' forecast. You can see it goes from 5.2, where it is today, expected to go to 5.1 tomorrow for June. And then it dips away and ends the chart at the middle of the target range at 4.5%. So where they had said the risks to that are balanced, they're now saying they're to the upside. So two things happened. One was they changed their forecast a little bit lower, but they changed the outlook and the risks to the upside. So those are all hawkish sounds coming out of the central bank. But what did they do? Two of them voted for a cut, 2 out of 6. So they were one vote away from a split decision, which goes then to the governor. So I would say the actions were dovish. They're telling the market, which they like to do, central banks, they like to signal that cuts are coming. And you said, will they wait for the Fed? Well, they must have thought this through, because the Fed meets on the 18th of September and the SARB meets the next day on the 19th. So they're going to have the luxury, as it were, of seeing what the Fed do the night before. And, you know, a lot does ride on the US economy. We saw that in the correlation between our bonds and the US bonds. So any tweak that they make, as we heard Karim say at the beginning of the year, discounting 7 cuts and then pricing it out back to 1, and now we're sitting at just over 2, the world focuses on what the US is doing. So I think, you know, if the Fed go, we'll definitely go. If the Fed don't go, perhaps we'll move in 25. It definitely feels like the next move for us, of course, is down. And here's something that we look at as fixed income investors. The lines on the screen go across left to right, and that's the implied rate path in South Africa for monetary policy. And the yellow line is where it was just after the elections and the May MPC. And you can see starting at 0, not even factoring in a full interest rate cut over the next 2 years. Whereas the white or grayish color line was taken just after the last MPC when we spoke, and it's discounting by next year a full 100 basis points of cuts. So this is important for us. That's going to help the short end of the curve. If this plays out, if we get 100 basis points of cuts in the next year or even more, that's going to bring that yield curve in the front end down, and any good political development or economic development will bring the entire curve down. So that's where we're sitting. Before I should also mention they made a little bit of discussion about real rates, that neutral real rate that you and Karim spoke about earlier. And they made explicit mention of that real rate being 2.5% in South Africa. That's something to consider. And I'm going to show you here on the chart that real rate, but this is a little more crude. I've just taken the last year's inflation and I take the repo rate and subtract the inflation from it. And the purple line is that difference over 20 years. Now, the first 10 years averaged 1.4%. The second 10 years, you can see the white line there averaging 1%. Government's telling us it should be 2.5%. And if we look at the purple line, it's currently just above 3%. So it's not as simple as saying, well, okay, it can come down 50 basis points. It's going to move with inflation. As that comes down, it'll move higher. We think that's going to be about 70 basis points. And then they're going to cut by 100. That gets us to 275. To me, that means we've got space for more cuts. If inflation plays ball, if the rand plays ball, and if we get more interest rate cuts, then that's great news for bonds. However, if that doesn't play ball, what it does mean is real rates remain high, even at 2.5%. You're getting 2.5% inflation beating returns from fixed income without taking any duration risk. So this really does mean that fixed income is a great place for our investors at the moment. You can do nothing and get 2.5% real. And if you choose a little bit of duration and a little bit of a strategy, we're getting really good inflation beating returns out of fixed income. So it is an exciting asset class at the moment.
Those are some fascinating figures you showed there, James. I must say, I thoroughly enjoyed that. You make an interesting point there that it almost sounds like a free lunch that you're selling, James. Is that bonds are looking really attractive from a real yield perspective, and like you say, you just invest in it and you earn it. But I mean, if I can briefly ask you, and I'm at pains to say that we are very fast running out of time, but you know, I mentioned in the intro that the ALB jumped 5% in June on the back of election results, and you know that we should not misinterpret fixed income to imply fixed returns, because investors might look at that and they might also look at the last 12 months where the ALB, for example, lost 2% in 1 month, gained 2% in another month, jumped 5% in June. You know, this somewhat contradicts the traditional textbook assumption of bonds being risk-free. You know, it does sound quite equity-like in its return profile. Now, how do you explain, James? And you know, in a quick and dirty 2-minute explanation, how do you explain simply to investors where fixed income should fit into their investment portfolios, and especially as relates to investment term being key in order to reap the rewards that you're talking about, the seemingly free lunch, these yields that you're earning? What must your term look like for you know, earning these rewards, at these currently elevated yields offered in the market? How do you talk to investors in a simple manner to say fixed income is an attractive asset class? Yes, there's volatility potentially in the short term, but what is your investment term? And over that investment term, will I be earning the 10% that I'm seeing on the screen if I invest for 10 years? Or might I actually lose money if I just invest for a year? How do you position fixed income as an asset class to your investors?
You've asked the most important question for fixed income investing, Nico, at the end, and I appreciate that, because you can't scan the product and say, that's the yield I want. You've got to correlate the investment term, as you correctly say, with the expected yield. So when it comes to bonds, we're talking 1.5, 2 years up investment period. Then you're going to get those higher yields, but you're going to get the volatility removed with time, which is important. If you're expecting to use the money, if you require liquidity, then we would prefer a shorter, like a money market fund or a cash plus or income type fund. So you're going into an investment and you've got to say, what's my strategy here? Look at the chart on screen, for instance. You can see the green line, that's money market. No volatility left to right, goes across, and it's done 4.6% roughly year to date. The red line is bonds. You can see below, above, but ending higher. Same for equities, the orange line, property, the yellow line. That's the volatility that you've got to zoom out with your investment horizon. And that then smooths, and you'll get those higher yields. Another point to consider, again, going back to the yield curve, is the steepness. You're going to get capital appreciation if you're on a part of the curve that isn't flat. So look at where those two arrows are. If you invest in those bonds and you just wait a year, you're going to value those bonds at a lower interest rate next year or in the future. And so there's a capital appreciation implication for the investment. So strategically, your manager needs to select the right part of the curve, factor these things in. And as investors, we need to be very clear, ideally, what do we want this investment for? Is it a short period of time? Is it a place to park cash? Then we would go with a Satrix money market type fund. If we're more structural, if we're wanting this to contribute to a pension, to a longer term savings pool, then it's an income fund or it's a little bit of bonds too. We've got to be aware of that volatility and zoom out, as I say. And then, across the spectrum of fixed income, there's value at the moment and it's a brilliant place to be. But we do advise investors not to look at the statement daily if you're a term investor, and then you're going to have a great experience. I think South African fixed income is the place to be. We've got a little bit lower growth at the moment. That's going to pick up and improve. That's going to look good for bond yields too. And we've got high real rates in the short end. So I think a nice balanced fixed income portfolio is going to be great for our investors.
Phenomenal. And I think you've answered one or two of the questions. I see there's quite a few questions coming in thick and fast. You answered one or two, and the first being that South African bonds are looking attractive. I think, I would absolutely agree with you there. There's two other questions that's coming in, and both of them relate to ILBs. Now, it's something we haven't touched on, and it's an interesting asset class. There's also a question on the difference between the OLB and the Govy. Of course, the OLB includes more than just government bonds. It includes other parastatal debt instruments as well, if that answers your question. But I want to get to those two interesting questions on ILBs and the role it plays within a portfolio and whether it has paid off in the last 2 decades. Or have we not really faced the ideal conditions for where ILBs pay off? Now, it's an interesting asset class. I've always thought about if you compare bonds, sort of traditional sovereign bonds to ILBs, linked to inflation. In my mind, when you buy a bond, the price you pay for it effectively locks in your forward inflation expectations, right? Across the duration of the bond. It locks in an inflation expectation, where ILBs, that inflation expectation is fluid, it's variable. And so if inflation expectations spike, then you're better off positioned in ILBs. If my understanding between the investment case for it, where it can add value in your portfolio is just, it offers that protection against if inflation expectations spike. Now, that's how I understand it. You can absolutely differ from me there, but how do you see ILBs, James, and how does that fit into your portfolio? Is there an investment case for it from this vantage point, ILBs?
You've explained it really well to the audience, Nico. I'll just add to that. So the way I look at inflation-linked bonds, it's for a liability to hedge. It's to hedge like an insurer or a pension fund that knows its pool is exposed to inflation. They would buy inflation-linked bonds to hedge against the uncertainty of inflation. As investors ourselves, we would look at inflation-linked bonds and we would say, it's an asset we buy to hedge our capital against inflation as determined by the current break-even. So that's what we've got on the screen coming back to that. So let's look at the 5 here. It's saying let's call it 4.5, 467, that line at the moment. If I buy an inflation-linked bond, inflation, for me to make a capital return on this transaction, inflation needs to average higher than 4.67 over the next 5 years. I would submit that is unclear. I would say it's probably not a great trade. We know the central bank wants to get that target lower. I think we're going to find inflation closer to the middle of the target band. And so that is not necessarily a slam dunk. However, you might say, I'm hedging like a grudge purchase, like insurance. I want to hedge against the uncertainty. And I don't think we're going to have this smooth inflation outlook. Then you buy an inflation-linked bond. Where inflation-linked bonds make sense is when those break-evens are low. Looking at this, an objective investor might say they're the lowest they've been over the last let's say the last 2 years. Coming out of COVID, they were very low, and that was a fantastic time to buy them with hindsight. Where they are at the moment, you might look at this and say, actually, 4.5%, 5%, I'm willing to add a little bit of that to my portfolio. I've preferred as an investor the liquidity from nominal bonds and to manage the interest rate duration and the term premium myself in a more liquid fashion. But inflation-linked bonds has their own specific purpose, and that's to lock away any exposure to inflation, because as you invest 100 Rand, the 100 Rand inflates. So at the end of your investment, you'll have an inflated 100 Rand, and then on top of that, you'll have received interest rate coupons. So it's a very technical and specific investment preferred by liability hedgers. But for the simple rule of thumb, look at the break-evens, ask yourself, do I think inflation will be lower or higher than that over the period in question? And that will answer whether you think they should be added to the portfolio. I personally am not putting inflation-linked bonds in the portfolios at the moment. I think there'll be more juice out of the nominal bonds as those term premiums, we hope, contract further and monetary policy is cut further. As monetary policy is cut, inflation over the longer term is then de-anchored somewhat, and that's the time that inflation-linked bonds may be more appealing. I hope that kind of covers it. It's a technical question, though. Thanks, Nico.
I think you've done an expert job of covering that. And I thank you, James, for your wonderful insight. It was an absolute treat having you on, and we're going to have to get you back because we've run out of time. And there's so much more that I want to ask you and also ask Karim. Time is just not on our side. So I want to thank you, James. I want to thank you, Karim. It's been a wonderful session, and I'm sure you at home enjoyed this as well. A recording will be made available of this webinar that you can again watch. And I think there's a lot that both of our speakers said that you might want to recap. But thank you for your time. Thank you for joining us. And we really hope you enjoyed this as much as we did. And we'll see you next time on another edition of our Index More series that Satrix hosts in collaboration with BlackRock. We will see you next time. Thank you so much.